What are you thinking about not just the downgrades, but in general, this broader refocusing of attention on, some of the underlying issues that we know the regional banks have been dealing with and where those stand right now?
Yeah, so, still kind of a work in progress. We come off of what was actually a slightly better than expected second quarter. Now, there are certainly a lot of pressures, and I don't want to minimize those. But I think what happened in the earnings season is that investors breathed a little bit of a sigh of relief that their worst fears from earlier this spring did not come to pass. Deposit flows have clearly stabilized, and that's great. Having said that, I think with this scream upward in yields that we've had over the last week or so, that's sort of caused some of this enthusiasm to wane. The downgrades we got today from the ratings agencies, that's weighed on sentiment as well. And I think what a lot of investors are doing is saying, look, we've gained about 20%, albeit off very depressed levels over the course of the past month. Maybe we take a deep breath and sort of recollect our thoughts, because the fact of the matter is that we do still have a long road ahead of us, whether it's with funding costs that'll pressure net interest income, new capital rules that will pressure profitability, the eventuality of a credit cycle, et cetera. So there's still a lot to worry about.
Yeah, and what do you do, I guess, in terms of sifting among the banks in that type of environment where it does seem as if, we have all of these, funding issues and margin squeezes on the way, presumably, to an economic downturn at some point that always tends to pinch the banks as well?
Yeah, so we're trying to stick with quality to the extent that we can. In the largest cap space, JPMorgan remains our favorite large bank. To us, it's just in rarefied air with its ability to generate superior returns despite this uncertain environment and some of the most punishing regulatory requirements already in the industry. So that's just an excellent company, and we think it'll continue to be so. If you get into the larger regionals, we like U.S. Bancorp. We think that's a kind of unique opportunity insofar as they got hit earlier this spring on capital concern issues. So they have had a little bit of ground to make up, but I think they've done a really nice job of laying out for investors a roadmap of how they'll advance their capital levels over time. And the fact of the matter is that they generate capital internally at a more robust clip than virtually anyone else in the industry. So we think what you're getting is an excellent company at an historically discounted valuation. And then you go a little smaller, and we like Fifth Third a lot. High reserve, conservative expectations, good rate positioning, strong capital. So really good company at an attractive valuation.